Good morning and welcome to the Leadership and Insurance podcast. I'm your host, Alex Bonds, and I'm very lucky today to be joined by Nico from Foundation Capital. Nico, how are you?
Hey Alex, good to be on here, and thanks for having me.
Yeah, not at all. No, thanks for putting up with us because we've bothered you about 3 times in the last month, actually, uh, after we met at the ITC LATAM conference. So, look, as is traditional with the podcast, as part of our warm welcome, we always want to throw it over to yourselves to sort of just give us an overview of your journey to the world of insurtech, and then, of course, Foundation Capital and what it is exactly you guys are interested in.
Yeah, absolutely. Well, thanks again for having me. And yeah, it feels a little bit Groundhog Day here with this recording a couple times, but no, it's great to be on and excited. Kind of very top of mind for us. A lot of these themes, I think, within insurtech right now, and so happy to share. My quick background, I'm from South America, actually originally from a country called Uruguay. Stereotypically sort of football obsessed and all that fun stuff. So I'm sure we can have some stuff to talk about there. I grew up most of my life up here in the New York area where I'm based today. Spent 4 years out in Palo Alto, where I actually started my career here at Foundation back in summer of 2017. While I was at Stanford, they were kind enough to take me on for the summer. And really, I normally don't go into kind of too much detail, but I'll sort of tell on myself now that, Foundation took me on as a total charity case back then. I really, didn't know anything about anything, but I kind of just thought venture would be cool and kind of wanted to throw myself into the Silicon Valley kind of culture, having, spending some time out there coming from New York. And so that really was the start of my really kind of obsession with fintech and insurtech, because, as fate would have it, they kind of happened to put me on with the partner that had capacity to sort of babysit somebody that summer, was Rodolfo Gonzalez, who's now led a lot of our insurtech investing actually the last 6 years since then. And so I'm kind of eternally grateful to them. I ended up kind of coming back to New York after that summer. I spent some time in investment banking. I was on the Bank of America Merrill Lynch's Latin American M&A team. I spent some time in corporate venture capital, kind of with a little bit of a more strategic hat. I also spent a summer at City Ventures here in New York with Luis Valdich, who's still running that team. And ultimately got the opportunity to kind of continue my passion in fintech by spending a couple of years at one of the big growth equity firms, General Atlantic, specifically kind of on their financial services and fintech team. And that was 2020 to 2022. And so it was in a lot of ways sort of the time to be doing kind of series, B, C, D fintech investing. Certainly felt like drinking from a fire hose and was quite overwhelming at times. Obviously the kind of FOMO I think that we all lived, but really excited to spend a lot of time in insurtech over there as well. I participated in the team that did our coalition investment in the cyber insurance space while I was there, and so happy to talk about that as well. And then ultimately about a year and a half ago, I got a call from the old guys at Foundation to see if I wouldn't consider coming back to Foundation, and specifically to help kind of start our New York office over here. And so we've had a general partner named Angus Davis, who is sort of East Coast based and spends roughly half his time here in New York. I was very fortunate to be the first kind of full-time partner here in the New York team. Fast forward to today, I guess 14 months later, we're up to 3 folks full-time now, plus that sort of GP. And so kind of pushing for about to move into our office down in the Soho neighborhood here in New York. And so sort of excited that kind of things have been moving in the right direction there, and very excited to have done the boomerang and come back to Foundation kind of 6 years later. So feel very fortunate that kind of a lot of dominoes fell my way. And then, Foundation itself, we're a nearly 30-year-old venture firm. So founded back in the 90s, 1995, I believe, always focused on kind of early stage investing. And so what we like to tell our LPs and sort of other folks in the ecosystem is that, there are certainly relatively few brands that are kind of that 25 plus year kind of history. There are sort of even fewer among that set that have what I like to call kind of stayed in their lane, and so lots of folks have kind of gone on this natural progression of, wanting to grow the AUM, grow the management fees. And what that inevitably leads to is becoming sort of multi-product, multi-stage, multi-strategy. There's only so much money you can throw at seed, for example. I think the sort of predecessors of ours at Foundation have really done an excellent job of sort of keeping us focused on that sort of early stage investing, which is what we do well, and it's really the only thing we do. And so these days we're kind of very solidly seed investors. We talk about being high conviction, high ownership, high touch investors. And so it's a little bit of a kind of old school investing strategy that also comes from being nearly 30 years old, which is, no spray and pray. We don't have kind of 200, 300, 400 portfolio companies. We really try to intentionally concentrate the portfolio. And so in a practical sense, that actually means that we're limiting ourselves as partners in terms of how many deals we do in a given year, how many boards we can sit on in a given time, for example, so that we can really deliver on what we're functionally, all selling beyond just the capital, which is commodity. And that's to be very active, involved, and engaged investors. And so, in practical terms, we're typically leading investments, kind of looking for 15% plus ownership for a kind of sub $5 million investment. And so really anywhere from the kind of pre-seed to sort of Series A-ish, in this environment is fair game. We're sort of roughly split kind of 50-50 today in terms of our team. We're about 16 investors. Half of the fund and sort of half the team is dedicated to our enterprise strategy. And that's anything kind of B2B, typically concentrated out in the Bay Area, although with some flexibility. On my side of the world and on my team, the sort of fintech, insurtech, prop tech, and kind of crypto team is the other half of the fund, and very broad focus there. Obviously, kind of insurtech has been a big focus for us historically, a big focus of my time as well. One of the kind of cool things about Foundation is that we're all investing out of the same fund, and it's actually what's the word? Feature, not a bug, right? Where we're able to invest, kind of drawing on the resources and on the expertise from, for example, our enterprise team and I'm sure we'll get into some of the portfolio companies, but things like enterprise sort of software for large carriers, for fraud detection and kind of claims resolution. That's a great opportunity for us to bring a kind of 1 + 1 = 3 approach and sort of leverage different parts of the firm. So we are intentionally not a sort of pure fintech fund or a pure insurtech fund. And we get that question a lot from founders. Shouldn't I take money from a, pure insurtech fund or whatever it is? And, for us, it's actually the whole point is that we're not just that. And we can sort of bring the expertise from, not just kind of 30 years, but kind of a very broad kind of subset of the world. So, in terms of the kind of nitty gritty today, typically investing $2 to $6 million as a first check, anywhere kind of 1 to 10 is sort of fair game for us, and a really significant reserve strategy. So we're on our fund 10 right now. That is a $500 million fund just dedicated to seed, and we'll probably only make 55 to 60 investments out of that one. And so it's quite a concentrated portfolio and a significant reserve strategy. We also have a kind of dedicated follow-on fund exclusively for portfolio companies called our Leadership Fund, and we're able to sort of double and triple down there, after the reserves are exhausted. So we're kind of with companies to and through IPO is what we like to say.
Nice, thank you so much for that. And I think it's fascinating to talk about a fund that's firms been going that many times. And I was reading the statistics the other day, and I wish I had in front of me. It was just like the number of firms that actually make it past their first fund and into their second, and then the amount of. I was like, it's like watching the history of a really good band, and they have the great first album. It's like the second album. It's like there aren't many Oasis or Blurs in the world, or Foo Fighters. Pick your long-standing bands, and there's a reason, because it's difficult. And it's not the worst analogy either, because I think sort of getting creative with your strategies and relationships, and it is much more challenging, but particularly staying in your lane. And I think that broad lens is important now as well, because I think when we started talking about insurtech internally in our business, we started talking about it in a very narrow lens, which was digital insurance or neo insurers or whatever you want to call them, digital first insurance plays that offer insurance products, and B2B SaaS businesses that serve the industry. Now, I'm not sure that's enough, because now our clients might be cybersecurity businesses that want to sell into the insurance industry. They might be climate businesses that are of value to the insurance industry. And it's like, well, they're not by definition insurtechs, but it's important that we're aware of them. And, companies like Sonar do a great job of kind of collating all that information. But having that broad lens means you're more helpful in my world. But I imagine from your perspective as well, being a truly strategic investor, your investments want to know that you have that lens to view them through, and not just this, one box fits all in the insurance space. I'm aware that wasn't a question; it was just a statement.
Yeah, although it's a good point, on cybersecurity. That's another sort of kind of great example of that collaboration. On our sort of enterprise team, we've got, really 10, 15 plus year sort of deep cybersecurity experts on the investment team. And so, folks like Sig Trivedi, who's speaking at, RSA, even just a few weeks ago. And, he brings the kind of wealth of experience on cybersecurity. We're able to bring this sort of insurance perspective, and, hopefully it's that kind of 1 + 1 = 3 situation. But it's, there's lots of sort of areas like that, I think, in and around, for example, I'm sure we'll talk about, we've done quite a bit of investing in crypto insurance as a sort of category, traditional MGAs that are kind of, have the sort of on-chain underwriting chops to be able to analyze the risk, but that also kind of have the insurance expertise to be able to talk to reinsurers and capacity providers. And that's a great opportunity for us to collaborate with our kind of dedicated crypto team as well, that are, true DJ, right, and sort of they're really deep in these new projects and kind of the cutting edge of the blockchain, and we're kind of bringing a lot of that insurance perspective as well. So it's a great point.
I want to talk about a piece that you wrote recently, and we pushed this back because these are coming out, and we're going to share these articles with anyone that wants to see them. We'll attach them to the podcast and we'll send them out to people that are listeners, because they were really, really interesting, well thought out and put together pieces. And look, this is always going to resonate with both of us, because the title was, or certainly one of them, why the insurance industry desperately needs startups. And one, I think I wanted to start with, I was going to say why overarchingly, why do they need them? Like, what conclusions did you draw about the industry? But the other thing is, I think leaping ahead, it won't surprise anyone to say that my summation was that the industry has been painfully slow to embrace technology, and kind of unpick why that is. So yeah, I just wanted to dive into what were your big takeaways from that piece of work that you did?
Yeah, it's and happy to kind of have people read that as well as part of this. The sort of the piece was titled "The Emperor Has No Tech," which was a great turn of phrase from my general partner Charles Moldau, who kind of co-wrote the piece with me. This idea of kind of the emperor has no clothes, right? Where everybody kind of sees the emperor naked, but nobody wants to say anything because everybody assumes that kind of the other people see the clothes, and you don't want to be the odd man out, kind of not seeing the clothes. And so it's the same idea, right? Sort of, lots of carriers, many of whom are LPs. So obviously we sort of love working with them and really respect the carriers in the ecosystem. But in contrast to something like traditional financial services, they have sort of significantly underinvested in their R&D, really going back sort of a decade plus. And so, the sort of fun fact kind of quote that I think we had in the piece was, somebody like State Farm, which is the largest carrier by premium here in the United States, has something like 60,000 employees across their organization, full-time employees, not agents and things like that. The sort of largest bank in the United States, JP Chase, has, I'm sure, kind of in excess, of kind of 100 or 200,000 employees. They have 55,000 technologists just in their sort of technology org. And so that's data scientists and engineers, ML and things like that. That was also, I think they were recognized recently in Evidence kind of AI index of financial institutions. They were sort of 50% ahead of the kind of next closest competitor, which I believe was RBC. And so, when JP Chase has the same amount of people in their technology org as State Farm has in the entire org, up and down, it's no surprise that there's going to be a pretty big gap in terms of their technological capabilities. And between us, it's not like JP Morgan is sort of really cutting edge stuff either, right? So imagine kind of where some of these carriers are. The other kind of fun fact was this sort of a European Union, what they call their sort of World 2500 R&D companies, where they come out with that. I think every year they analyze sort of, the largest kind of spenders by R&D in the private sector in the world. And of those top 2,500, insurance, 2020 was the last year that we had the data for this. Only 9 out of 2,500 of the top R&D spenders were insurance carriers. And that's, 6 were in non-life and 3 were in life. Financial services accounts for something like 40 to 50. So it's also not, a ton. And obviously the vast majority of the rest is things like, technology companies. And so, it's a kind of structural underinvestment, I think, over years, right? And you sort of we didn't kind of put too much of the data in the article, but if you go to the sort of sources that are linked there, it's interesting that it's obviously quite cyclical, versus a technology company that's kind of constantly investing in R&D over time. In periods like 2008 and kind of the sort of 3 to 4 or 5 years in the aftermath, the R&D spending as a percentage of revenue dipped kind of dramatically. And so I think they're still kind of playing catch up, and they're perpetually sort of a few years behind the 8 ball, if that makes sense. And so the idea is, that's kind of been a structural sort of trend over the last, decade plus. We're now kind of, running head on into this kind of freight train of AI and generative AI. And, I'm sure kind of, unless people have been living under a rock, things like GPT-4 and kind of audio, sort of voice-based AI, text-based AI, image-based AI it's sort of going to impact every single piece of the sort of world of our society, of our economy. But it's sort of not hard to immediately, just off the top of your head, think of all the ways that it's going to impact something like insurance, right? And so the way we sort of kind of broke down the business of insurance, if you will, is this idea that you've got the sort of 3 pillars of oversimplifying insurance. Let's say you've got distribution, which is could be captive, could be channel, could be online digital distribution, like we've seen with a lot of these folks. There's the sort of risk assessment piece, which is the actual meat and potatoes, right? Hey, get an actuary to look at this thing, or get an AI to look at this thing, or whatever it is, and figure out like what is Alex's risk and what is the appropriate premium for that. Obviously, no bad risk, only bad premium. And then the sort of everything that comes post-sale, which is the servicing, the customer service, the claims automation or resolution, fraud detection, and all that kind of stuff. And so, the insurance industry's solution to each one of those 3 pillars historically has been people, right? Just throwing mass quantities of people at every one of those. And so obviously you've got the whole world of agents and brokers, which we can talk about in a little bit. You've got sort of actual, actuaries, no pun intended, looking at, tables and figuring out the risk for a certain thing, or oftentimes kind of with some light AI assistance. And then you've obviously got, the massive call centers of folks and the sort of claims agents and people kind of, again, devoting headcount to these problems. And there's sort of some things you can do. And we've seen that obviously the sort of offshoring, hey, you've got a call center in the Philippines instead of in Arizona. And so that will dramatically kind of reduce your costs, but it's only to a point. I think the sort of next big step function is going to be in AI. And again, it's not hard to see sort of how AI is going to impact each one of those. We think a lot about in the financial services practice more broadly about, hey, is AI, is this fundamentally a sort of revenue driver for financial services, including insurance, or is it a cost reducer? And, the sort of cop-out answer is both, but the question is sort of to what extent. Then there's the sort of whole other kind of layer of complexity, which is how are, let's say the bad guys in some way going to leverage a lot of this AI? And so it's not hard to, think about things like fraud, a mid-journey, right? Give me a picture of a totaled, Nissan Altima 2022 in gray and make the license plate be my license plate. Boom, done, right? And like send that to Geico. And who knows if that works today or not, but certainly kind of that stuff will get more sophisticated. And forget even the point where, we can already probably just using the audio from this podcast, train sort of an AI on both of our voices independently and, functionally recreate this podcast with the AI, or just have the AI call your bank account, pretend to be Alex Bond and call your insurance company and say, hey, actually that claims check, I need you to send it to a different address, please, because I just moved and I'm Alex Bond, right? And so
Nico,
there's a whole host.
We already have that software in-house here. So if I make
I knew this offer was too good to come on the podcast here. You guys were trying to clone me.
I'm trying to steal from you. No, but the scary thing is, so for about a year and a half, we actually don't use it anymore. But we had this. It was a transcript piece of software, and if we wanted to change something, as long as we had over 10 minutes of a person speaking, you could change the transcript. So you could type it out, and then as you play the recording, it would recreate that word that you've written down, and you're thinking, that's been around for a while. Like it wasn't new when we got it. So we're like, and that's it not correcting on its own. That's it not thinking on its own. That was me manually going in and doing it. But absolutely, yeah. I mean, I think that element is the worrying thing. But one thing I wanted to kind of sorry, interrupt and ask you. I think one thing that you and I sort of bonded on a conversation around, and I can't remember who. I think it was Brian Brian Falchuk that brought this up. One of the challenges and that we forgot about when investing in insurance is the best case scenario in insurance is premium less costs, and that's assuming there's no claims, right? And that's the best you can ever happen. So culturally, is that the sort of thing that plays against people investing in R&D? Because one of the things that I'm struck by with the insurance industry is that all these new entrants come in, and whilst there are growing markets of insurance, and of course more people globally are buying insurance, most of the time we're competing over quite established insurance markets with fairly established penetration rates. So all that happens is we shift money from company A to company B without growing the insurance pie, unless we invest in R&D. And R&D is still seen as like a cost function. When we see these innovation teams, we see them as a cost, and no one wants to put that much money in it or that much power or responsibility in it. Whereas with the true R&D, you can get investment opportunities. You can grow that pie, using that kind of pie analogy. Do you think culturally there's just that reticence within the industry, and do you see that anecdotally changing at all?
Yeah, it's a great point. You know, I think that reticence is absolutely correct. You know, there's sort of a lot of factors at play here. One is sort of that idea of, you know, hey, you know, anything that I spend into R&D is in some way sort of taking, you know, sort of food off the table, kind of slicing out the pie. Today, obviously, hopefully for increasing the pie in the future. And so, you know, the sort of mindset of some carriers is kind of hard to wrap their heads around that. You know, that's really why I think the kind of main conjecture of the post around InsurTech was, you know, hey, carriers, right? Let's sort of stop kind of treating InsurTech startups as, you know, a place to sort of put some of your excess paper, right? And hey, we'll just back the next MGA doing whatever. And let's start thinking about this more as, you know, these are the sort of outsourced R&D shops that you wish you had, right, at the carrier level. And so it's a lot of benefits, right? It's off balance sheet, you know, all that kind of stuff. You know, there has to be a process for carriers, I think, to partner with these startups from a sort of significantly earlier stage. You know, I think about our company, Evolution IQ, for example, which very much at that intersection of, you know, enterprise software for large carriers. For those that don't know, Evolution IQ is a sort of very advanced kind of AI machine learning platform for large carriers, specifically in the short and long-term disability and workers' comp spaces. And what they're focused on is using this AI to identify those claims that have the most likelihood of sort of ballooning into, for example, a lawsuit or into this kind of very long tail of years of losses. And so they're able to sort of proactively identify, hey, this is the sort of next best sort of action to take in this specific case for the kind of case, the return to work process for those carriers. And, you know, one of the things that is really interesting about Evolution IQ, we as investors, right, you know, companies are always pitching us this kind of mythical land and expand, and that's great. We love land and expand, but oftentimes it's really just an excuse for, you know, the kind of initial contract values not being worth the squeeze on a sales cycle, for example. And no, it's going to be land and expand. But, you know, Evolution IQ has really done it to an extent that I've never seen before. You know, so I won't kind of give too specific numbers, but, you know, well in excess of kind of 10x sort of within the first 18 to 24 months inside of a carrier, where they're sort of able to launch additional businesses and additional products. And then even backwards looking for some of those carriers, you know, this is a sort of proven 10x ROI, not a kind of estimated, but a proven 10x ROI, even on what those carriers are spending. And yet it still is a sort of 12, 13, 14 month plus sales cycle with these carriers, right? And so it's sort of as close to a no-brainer as you can get in kind of enterprise software for the insurance industry. And it continues to be a sort of huge slog to sell to these folks. And that's never going to sort of fully change, but there are so many sort of, I think, promising fintech and insurtech startups that have kind of died on this hill of, you know, oh, like, you know, Bank of America is really interested in buying our product, and like, you know, they keep wanting to do meetings every 2 to 3 weeks, and it's great, and we're about to, and like that is still an 18-month process, and then it's kind of not really conducive for the sort of startup numbers, right? The sort of math and startup math. And so there's got to be some way that carriers can do that. Some carriers have done a great job of spinning up, for example, venture arms to invest in those companies and then become advocates of those companies internally and sort of move the needle a little bit faster. And we're, kind of thrilled to be partnered with lots of those different types of venture carrier venture arms across the portfolio. But we're excited to see a little bit more. And I think carriers are starting to kind of realize that this is coming, right? There's the sense of nobody gets fired for buying IBM, right? In insurance, I think nobody has nobody has gotten fired for not kind of turning the whole organization over to AI. And if anything, lots of people have gotten fired for trying to do that kind of quickly. I think hopefully we're at an inflection point here where that's going to change in a big way, and all of a sudden I think about Bloomberg GPT, for example, right? Nobody got fired for not building FactSet GPT, but maybe now somebody will get fired for not building FactSet GPT. And so they're going to feel that sense of urgency. And I hope it's the same in the insurance industry.
Yeah, I mean, we're seeing that anecdotally. I mean, I always think that we're a good bellwether when we work in the kind of recruitment industry to say like what's actually transactionally happening, because it's like the investment has to come and then the people need to deliver that. Obviously less people, hopefully, when we're talking about technology driven things per project, but they are there. So just anecdotally, we've been filling out these innovation teams quite recently, and most of their role is actually shepherding in new ideas, new technology, and then championing them and driving them to actually something they move. So we're moving that 12 to 14 month sales cycle to something like a 6 to an 8 month sales cycle, because again, going back to the conversation I had with Brian on the podcast previously, these really good ideas are dying because they cannot get to the next round, because they cannot get these deals over the line. And if the industry's not going to invest in R&D, and the numbers are pretty, I looked at the numbers on it's pretty solid, between 7 and 9 insurers represented in that top 2,500 or 25,000, what those 2,500 R&D spends. It's like that for 10 years. It never shifts, it never goes down. It's between like 7 and 9. If they're not going to spend the money, then they need to utilize these startups and bring them on board quicker and faster and better. And the ones that are going to succeed in the future appear to be the ones that are embracing that.
100%. Yeah, there was this interesting for folks kind of listening, there was an interesting article literally just yesterday in the Wall Street Journal, and it's titled "Technology was supposed to transform insurance pricing, but it hasn't," right? And so, people talk about these kind of 900-pound gorillas in the industry and all that kind of stuff, but the fundamental insight of why has, for example, Root and Metromile and sort of Hippo and all these guys sort of struggle dramatically is because it turns out that there's not a lot of need to sort of revolutionize pricing in consumer standard auto, right? Sort of Alex, I won't guess your age, but we'll say he's got a beard, he's bald, and he lives in London, and he drives this kind of car. I mean, Progressive knows exactly how often you're going to crash that thing. And so the only way that some of these digital guys have competed is, first of all, on digital acquisition, which is not sustainable in the long term, and we obviously seen that play out. And then, it's this kind of death spiral of competing on price. Lemonade in their S1 said it very clearly, right? We will never be profitable under the current iteration of the business, and it turns out now, obviously, in the public markets, profitability is not for losers anymore. And so they've kind of struggled dramatically. That's one of the areas that we focus on quite a bit. I get this question once a week, and I think we've talked about this before, oh, you're not still doing insurtech investing, are you? And it's like, no, of course we are, duh, right? And then the second question I get, well, okay, fine, you're doing insurtech SaaS, but you're not doing MGAs, God forbid, are you? And it's like, of course we are, right? I mean, but it's about sort of picking and choosing the right areas. And so for us, specifically on the producing side, it's all about next generation risks that require that kind of next generation AI, ML, data underwriting. And so turns out it's not consumer standard auto, it's not renters, it's not kind of standard home necessarily, but it is things like, for example, cyber insurance, which we've talked about, crypto insurance, which we've talked about, even sort of specific niches within kind of established existing spaces. So workers' comp, for example, going back, however many decades. We're investors in a company called Insurate, which is specifically very narrowly focused on kind of heavy industry, sort of high risk businesses that the kind of traditional carriers or the state carriers will just kind of price in the high risk bucket and kind of crush them. And we're able to sort of cherry pick that risk using a ton of alternative data that's kind of proprietary to the model to find out, hey, this sort of, industrial factory is very different from this other one, right? And so actually cherry pick that risk and be able to actually significantly compete on price as well. It's things like embedded insurance, for example, right? And so using kind of AI, embedded insurance has existed, I think, for quite a while now. I think most people's mental idea of embedded insurance is like, the sort of AMericanAirlines.com checkout page, the Allianz button that they try to scare you into buying it. God knows I'm never buying that crap because everybody has this sense of it's like a home warranty, right? Everybody has a sense of, no matter what happens to me, I'm sure they're not going to pay. There's going to be some exception in the fine print that means that they're not going to pay. And so it's a crap product because it's completely static. The only thing that changes functionally is the price. 1,000,001 exceptions. You're sort of pretty convinced that it's never going to pay out, or you forget you have it, or whatever it is. Now we live in a world where sort of policies can actually be delivered, kind of in some ways dynamically, right? And so, splicing and dicing different pieces of that policy. We've got a portfolio company named Pattern Insurance, which is, enabling kind of online, travel and recreation and events companies to sell embedded insurance, but it's sort of very much customizable product. And I think the future iteration of the product is going to be, not just sort of customizable to what the sort of human behind the screen thinks, for example, the event organizer, but really kind of black box, letting the robots decide, like, hey, for whatever reason, because of all the data points that we've gathered on Alex and the event and the weather and the time and this, that, and the other, we think this specific combination of the policy is going to be the best. And so, to give an example, right, a trip to Miami, let's say, right, and you're going for 7 days, maybe V1 of that embedded product says, hey, if it rains, 4 out of the 7 days, like, we'll pay you some amount of money. We'll reimburse you because, hey, that was a bad trip. And so maybe you want that sort of peace of mind because it's your sort of beach holiday. Yeah. The sort of V2 and V3 of that is actually the robot is going to, on some kind of Pareto curve, some like frontier of equally profitable combinations of policies, pick the one that you're most likely to buy, right? And so, maybe it's the same profitability to sell you a 4-day rain policy at X price versus a 2-day rain plus 2-day cloud plus 2-day barometric pressure below something for another price, or maybe it's some infinite combination of these outcomes. But that last one that I gave you, like, you're never going to buy that because you don't even know what I'm talking about, right? How do I conceptually think about 2 days of barometric pressure versus 2 days of clouds versus 2 days of rain? And so they're going to be able to identify in a sort of very black box, human hands-off way, what is the thing that's going to make Alex most likely to click. And so maybe it's, hey, 2 days of rain and, 2 days of clouds, let's say. And so that's, something that, for example, a Pattern is working on, a company called Seal, which is doing sort of returns, kind of dynamic returns assurance policies. And so able to very specifically identify sort of at the SKU level and at the sort of individual consumer level, what their likelihood of, for example, returning something is, or actually getting into some parametric insurance as well. Like, hey, if Alex, if this package arrives after next Wednesday, we'll just pay you $10 as a credit, right? That's kind of a, if then type of thing. And so that's a lot of the focus there.
Yeah, and I think the embedded solutions is fascinating because I think about my own buying behavior, and exactly what you're saying is, like, if I see someone tries to sell me travel when I'm buying a trip, I'm not buying it because I know it's not going to be great. And even if it is, I don't trust it. And it's also not, it's presented very much as it's not something they do. It's like when people buy watches that are not made by watchmakers. I have a sort of aversion to that. But the point I wanted to get onto was that now we have the tools to not only sell me bespoke insurance policies that are relevant to me. And I was really smiling when you were talking about holidays, because I was thinking, I've been to Athens and it snowed. I went to Tel Aviv on holiday and it rained, and I've just come back from Qatar and it rains about 8 days a year in Qatar. It was raining then as well, so I need this insurance in my life. But it also allows them to kind of personalize as a brand, but also to me in a language I understand. So you can sell me that with some marketing at the point of purchase, that is relevant to me. You can put it in a, you know, I love marketing, and I did my degree, basically a marketing degree, and it's like the personalization of that also comes with selling it in a personalized way, because we have got the tools to say, right, this is the personalized product, this is why, these are the marketing touch points, and that can all be done at the touch of a button. So my experience and yours will be completely different, and it sells to me in a way that says, Alex, do you want to, I don't know, do you want to sit on the terrace and drink those sunshine beers? Well, if that ever gets spoiled for you, here's the cover. You know, I don't know. Like I think that's the next step for me, because people still don't want to buy insurance. They don't want to buy it. It's a thing. It's a thing that you feel, oh, you have to because you're mandated by law, or you feel you have to protect an asset or something. But really, it's not this kind of enjoyable experience, and I don't think it needs to be that way. And I think the thing that, you know, we love to beat up on some of the big insurtechs, but some of what they've done well is kind of make it a bit more fun.
Right.
You know, we've got Dead Happy in the UK, the life insurance business. They seem to have done well by making it kind of seemingly quite fun and some funny adverts. They did push it horrifically too far, but we won't talk about that. We've talked about that before. But I think trying to make it personalized is super interesting. You touched on valuations, and I wanted to go back to that point, because you and I had a really good conversation about valuations before. What's changed in the last 12 months? Because valuations have obviously dramatically changed. How are we valuing insurtechs now? And what within the current process do you think we kind of need to address? Maybe it's industry, because you need consensus, right, to build business valuations. That's the problem, is the consensus has gone out of the window.
Yeah, it's a great point. You know, this is sort of relates to the kind of second post that maybe we'll distribute as well, which we came out with in March, and it was sort of more kind of fintech broadly, but I think it's especially applicable in and around insurtech. And this sort of central conceit there was, you know, a lot of the pain that we're seeing in and around fintech, insurtech, all this kind of stuff now, and frankly more pain to come going forward, is because of this sort of plethora, I mean, this real tsunami of kind of tourists, what we call tourists. And by the way, I'll sort of ruffle some feathers here. It was investors and founders alike. So I'm not just kind of crapping on investors here. The sort of, you know, types of folks that kind of were just chasing the, you know, fintech was the kind of hottest thing since sliced bread, you know, for a year to, you know, 2 to 3 to 4 years there. And there was this sort of kind of tourist mentality of, you know, hey, you know, if it's fintech, it equals sort of, you know, some ARR multiple, and we're going to trade at, you know, 15 times ARR. And obviously some of them got done at hundreds of times of ARR. And, you know, really the sort of first thing to notice is that, you know, there's no such thing as fintech, right? I mean, it's not this monolith. Fintech and insurtech, I'll sort of lump those together. It really is this sort of matrix of, you know, probably, let's say 30 different sort of subsectors on the kind of x-axis, and maybe 12 to 15 different kind of fundamentally different business models on the sort of y-axis. And so, you know, multiply, you know, whatever that is. And I mean, you're looking at hundreds of sort of possible permutations of different types of businesses that we all kind of lump mentally together into fintech. And so that was kind of problem number one. I think insurtech especially suffered from this, where you've got not only fintech tourists, but like fintech and insurtech tourists, where, you know, a lot of the sort of big kind of consumer insurtechs, I think a lot of their investors came in and just mentally said, you know, this is consumer fintech. And so growth is good, and it's all about the CAC and the growth number, and that's it. And, you know, it turns out that actually insurance is quite a complex business. You know, I always use the analogy, I think, especially for tourists, that, you know, I think a lot of people have a innate aversion to something like lending, for example. And lending is very scary, I think, as humans, because you're taking my pile of money here and I'm giving it to you. I'm giving it away. And like, I'm crossing my fingers and I hope and pray that one day it comes back. And so people, I think, innately understand that is risky, that's scary. I always think about insurance, let's say a carrier, it's exactly the same thing, just in reverse, right? And so I'm getting in money today, and then I'm hoping and praying that it doesn't go out in the future, right? When there's a hurricane or a fire or whatever it is. I think mentally people don't kind of connect those two. And so, you know, whereas lots of people said, oh, lending bad, I don't want to do that. Lots of people said, you know, insurance good, right? And it's all about the growth, and it's all about the top line, rather than, you know, things like a loss ratio and combined ratio. I'll actually get to your question about sort of how companies are being valued, but I always like to share this. I won't sort of embarrass anybody, and I won't sort of mention any company names, but when I was at General Atlantic about 2 years ago, we were looking at a sort of very large insurance company that was, well, I won't say what they do because that would probably give it away, but it was sort of considering a SPAC. And so they were doing a pre-IPO round and, lots of big numbers getting thrown around. And, in one of our kind of diligence calls, we were speaking to the kind of the sort of chief underwriting officer, and the CEO was on. And I had some throwaway question like, oh, this number for last quarter, in Florida homeowners, let's say, does that include IBNR, right? Incurred but not reported. And the chief underwriter's jaw dropped. I mean, I can't even make this up. The guy's jaw dropped. And he said, we have raised over 10 years of this company's life cycle, hundreds and hundreds of millions of dollars from, dozens of like brand name referenceable investors. And not a single one of them knows what IBNR is, much less has ever asked me about it. And I mean, then my jaw dropped, right? Because it's not like I'm some insurance genius either. I mean, I hopefully know enough to be dangerous, but I mean, I couldn't believe that sort of folks were handing out sort of tens and hundreds of millions of dollars, not even sort of understand. It's like you don't know what net revenue retention is, and you're trying to invest in software companies, right? And so that's the kind of world that we're living in. Today we're obviously living in a very, very different world, and we continue to be sort of very active in and around insurance, MGAs, software, neo carriers, and things like that. The key though is just everybody going in eyes wide open that it sort of it's almost like there's no bad premium, there's no bad risk, there's only bad premium. It's like there's no bad entry multiples, there's only bad like exit multiples, right? And what I mean by that is you have to know what that exit multiple is going to be, how a certain business is going to be valued by the public markets. And that means that sort of no matter how you get in at the beginning, like if you sort of go eyes wide open in with the end number, then nobody's going to be kind of surprised to the downside. And so, insurance, MGA carriers at acquisition, right? MGAs and carriers, these things, high growth, are probably trading in the sort of low, single digits kind of multiple of GWP. Whereas, in the last few years, lots of folks are valuing them. One, you hope a lot of these investors knew that it was GWP and not revenue, because that actually is not even guaranteed, I think, unfortunately. But two, they're valuing them on sort of, tens of times a GWP and, dozens and, even hundreds of times revenue. And that's all going to kind of unwind. And so, today I can sort of share what we're seeing broadly speaking in the sort of market in fintech. And I think insurtech is broadly speaking the same, which is, at the kind of early stage, pre-seed type of companies are anywhere from kind of 8 to 10 to 12 type of valuations, kind of true inception stage companies. More kind of a seed where there's sort of hopefully something of a functioning product. We're starting to at least see towards some amount of revenue, but if not kind of have it already, that's more in the sort of 10 to 20 to maybe 25 sort of on the high end. And then series A's and beyond are frankly not really happening that much. And so we've certainly seen a lot of pullback in insurance. I mean, we've seen pullback in fintech broadly, but now's the time to do it, right? It's Buffett's greedy, fearful, greedy. The academic piece of the puzzle will tell you, 2001, 2009, hopefully 23, 24 are these kind of outperforming vintages because of lower competition and lower entry prices. It takes two things to do that as an investor, I think, to lean into those. One is the capital, and we're very fortunate to have amazing LPs who kind of have continued to provide for that. And two is you kind of got to have the courage and the guts to lean in, and that piece is kind of we're always searching for, I think, eternally as investors. But that's what we're excited about going forward in this year, right? Is actually now's not the time to lean out of insurance and insurtech. Now's the time to actually lean in. So that's what we're going to plan to do.
Yeah, it's that tough times becomes better businesses as well. There's always been that evaluation of stuff. So absolutely. Just lovely way to kind of segue into probably what's my last question is really just to kind of, what's coming up for you for the rest of this year? What are you excited about? Is there any, I know we touched on crypto and embedded, and I know you've got portfolios in the space, but is there a bit of a gap for you in the offering of insurtechs that you're on the lookout for? I've told you before, I'm obsessed with claims technology businesses, but I know Evolution IQ plays a lot in that space, and they're a business that we're aware of. But are there any kind of particular themes and niches that you're looking for?
Yeah, absolutely. And again, we're sort of, very much leaning into this environment. I'd say kind of broadly speaking, anything kind of in and around insurance and insurtech, whether it's producing kind of MGAs and neo carriers, where it's on the software piece, whether it's sort of the kind of true sort of AI enhanced vertical SaaS, we didn't talk about, but some of our kind of agent and broker enablement businesses like Agentero and iLife are sort of using a lot of AI there as well. Very excited about that and all those spaces. I think broadly speaking, kind of anybody who is building or actually considering building, in InsurTech at that early stage, we'd always love to chat. And for us, we especially interested in engaging with founders kind of really at the outset of their entrepreneurial journeys. We're oftentimes actually speaking with folks even before they've left their current companies, right? And so obviously we know discretion, and we're always excited to sort of meet folks as early as we can. And especially again, sort of I'd say that the sort of four big areas, maybe three big areas, kind of, next gen underwriting for next gen risks at the kind of MGA side. So that's cyber, crypto, workers comp, light commercial auto or informatic as well, certain e-commerce types. And there's a whole world of like AI model drift insurance that we're looking at now. When the lawnmower, autonomous lawnmower kills somebody, like whose fault is that? Like all that type of AI risk we're especially excited about. There's the embedded insurance kind of 2.0, like we call it. And so that's a big area of focus for us as well. And then the kind of, vertical SaaS and sort of software for insurance. So anybody who's building in and around that space or considering would love to chat. At a personal level, I kind of can't say too much, but hopefully going to announce some good news here on our next fund in the sort of relatively near future. And then I personally kind of am always on the conference circuit for InsurTech. I'm speaking at a couple panels at InsurTech Insights US here in a couple weeks. I'm not even sure if this will be out by then. And then obviously in the fall, ITC Vegas and others. And so always happy to meet different folks. And then the sort of final pitch for Foundation is, we've got folks here in New York on the West Coast, but we invest US, LATAM, which actually we didn't chat about, but maybe we can link to the sort of LATAM a quick podcast. So we invest US, LATAM, Europe, and Israel. And so always happy to chat to folks. And we're always traveling quite a bit and always great to meet folks on the road as well. So thanks so much for having me, Alex.
Not at all, Nico, and I will see you at almost all of those conferences because that's
no rest.
Yeah,
rest. Although remember to get that customizable travel insurance there from Pattern in case it rains here in New York.
I'm on a couple of panels on both of them, I think, as well. So no, I look forward to meeting you again face to face. You've been really generous with your time as ever, and I think we could do this all day. But thanks very much for your time. Appreciate it, Nico.
Thanks, Alex.